Hello everyone, welcome to today's lecture. So today we are going to continue our chapter number 9. So before we proceed for the discussion of the chapter number 9, like whatever we have discussed apart from in the last session, any doubts with respect to that? Any doubts? Because I want questions to be asked from your side, doubts to be asked from your side, and the more you will ask the doubts, the more you will understand the particular topic. Any doubts? Okay. If no doubts, then not an issue. We can have a quick revision of what we have discussed till now in chapter number 9, and then we'll proceed ahead. So, what we have discussed in chapter number 9, we discussed about the related service. Related service is nothing but the non assurance engagement where we are not issuing an opinion. It's in kind of an agreed upon procedure. Now, here in this agreed upon procedure, what we do, like there are multiple type of assurances: absolute assurance, reasonable assurance, limited assurance, and no assurance. When I say no assurance over there, this agreed upon procedures come into the picture because agreed upon procedures does not have any kind of assurance involved into it. Okay, so that's the agreed upon procedures. What we further understood in SRS 4400, anyone, what was the discussion that we had in SRS 4400? What you are required to do?
We issue a report on factual findings.
Absolutely correct. We issue a report on the factual findings. And there are minimum items which are there which are required to be mentioned in the report. Now, procedures is one thing that is depending upon the agreed, what is agreed. Second, there was important part with respect to the terms of engagement. What was that? Anyone? What was the important part with respect to the terms of engagement that we discussed in related service SRS 4400?
The engagement person should comply with this code of ethics issued by ICAI.
Okay, yes, very good. What else?
And independence is not required.
Independent is not required. Absolutely correct. Yes. So ethical requirements is still present. Why? Because we have to use or we have to comply with the code of ethics. And code of ethics is any which way is applicable, whether you perform agreed upon procedures, you perform limited assurance, you perform reasonable assurance. Ethical requirement, fundamental principles will always be there. Now the question comes on the independence. Are we required to have independence? Answer was no, because here we are not issuing any assurance. Okay, so as a result, independent is not required. However, if you are not independent, you have to report the thing in your reports on the factual finding. You have to state that you are not independent, and then accordingly you need to draft your report on factual findings. So compliance is not a requirement. Reporting is definitely a requirement. Clear? Any doubt till now? Any doubt?
And we use the word practitioner here, not the auditor.
Sorry?
We use the word practitioner, not the auditor.
Yes, absolutely. So we use the word accordingly in this particular scenario that it is a practitioner. See, again, SRS 4400, you may see the word auditor being used, but that is not the actual auditor. In SRS 4400, what we have used the word as an auditor some places, but that is not denoting the actual auditor of the particular engagement. But when it comes to the SRS 4410, we start away from the first thing. We are using the word practitioner. Clear? Okay. Now we will proceed forward for SRS 4410. We discussed last time also on SRS 4410 that what it includes. What is a compilation engagement? Can anyone quickly tell me what is a compilation engagement that we discussed?
It is the preparation and presentation of historical financial information.
Preparation and presentation of historical financial information. Very good. Yes. Now the question comes is, uh, does this reduce the responsibility of the management?
No,
Absolutely correct. It does not reduce the responsibility of management. Although we are doing the preparation and presentation of the historical financial information, or it may be other type of financial information, maybe non-financial information, but it does not reduce the responsibility of the management. Here, the objective of the particular practitioner or the scope is that practitioner, when engaged, will assist the management with preparation and presentation of historical financial information without obtaining any assurance on it, without obtaining any assurance on that information, and to report on the engagement in accordance with the SRS. So at the end, he will issue a report. I'll tell you why a report is required to be issued in this scenario, but a report will be issued. Now, again, as I said, it may be historical financial information. It may be other than historical financial information. It may be non-financial information under this SRS. So compilation can be of multiple type of financial, non-financial informations. And on all those places, this will be applicable. You can apply this SRS, not an issue. Clear? Okay. Now, there are scenarios where, compilation is required to be done. For example, like annual filings or for annual, compliances to comply with the periodic financial reporting requirement, to comply with the regulatory law, to comply, any particular contract, external party, or to support any transaction, any compliance, compilation can be there. So examples are given in your study material also on page number 9.10. Okay. See, when this can happen, so management can, okay, ask the practitioner to assist them to comply mandatory periodic financial reporting requirements based on that. Okay. To compilation as per or compilation required for the mandatory financial reporting under the relevant law or regulation. Now the examples are, let's say for example, you have a particular purpose, for example, preparation of financial information for internal use. Let's say for the presentation of the audit committee. Periodic financial information, that is quarterly financial information, or under a contract, or when you are, obtaining a grant. So there are multiple scenarios where you need a financial information. For transactional purpose, best example if I give you, slump sale, merger, acquisition, amalgamation, a lot of things are there. So at the transactional level, management may hire you, prepare me a balance sheet on this particular date. I want to do a slump sale. I want to do a merger. I want to do sell a divestment. A lot of things can be there. Over there, you may be asked to do a compilation of financial information. And the very important part is it is a non-assurance engagement. That means at the end, you will not issue any kind of opinion. If we are not issuing any kind of opinion, then in that case, what is the purpose of having a report? What is the purpose of having a report? Anyone? If we are not issuing any assurance, then why do we need a reporting in that? And the same thing, the reporting part is nothing but it is coming from your objective. of this particular SRS. So if you go through the objective of the SRS, where we have the objective of the auditor, there are two important things, or objective of the practitioner rather here. One is to apply accounting and financial reporting expertise to assist the management in presentation preparation. That is your main engagement of compilation. Second is the report in accordance with this requirement of SRS. Why? Why do you think I need reporting for that? Anyone? Why do you think you need reporting? No? Okay. We will understand this particular thing. We will go to for the compilation part, what is how to do the compilation. But before that, to understand why we need reporting, I'll take a question. Just a minute. Yeah. Let me read the question for you guys and then we will discuss this. Let me, yes.
CA. Rita has been engaged by Swift Logistics Pvt. Limited, a small enterprise, to undertake a compilation engagement for the preparation of its financial statements for the year ended 31st March 2025. The company's management is responsible for the financial information and the underlying data. While compiling the financial information from the trial balance and other records provided by the management, CA. Rita observed that the company has not recorded any provision for gratuity payable to its employees, which is a mandatory requirement as per the applicable financial reporting framework, as 15. She brought this non-provision to the attention of the management. The management responded that they do not wish to make the provision as it would reduce the reported profits, which they intend to submit to a bank for a new loan. They insist that since this is only a compilation and not an audit, her role is simply to assemble the data as provided by them, analyze the situation and advise CA. Rita on the specific course of action she must take in accordance with SRS 4410.
So now I will give you again a minute, read the question and then tell me what CA Rita should do in this scenario. And then we will discuss about the reporting part and everything in detail. But as of now, read this question first, and then we will discuss what she should do in this particular scenario.
The management should be asked to make the provision for this amount, provision for gratuity.
Okay. But here it's not an audit. What if they don't make? I'm not issuing any modified opinion or qualified opinion.
The practitioner may withdraw in that situation.
But why? What do you think CA Rita should do? Anyone?
Hello, good evening, sir.
Good afternoon. Good evening. Yeah.
Yeah, I think she goes to ask the information, the non-provision of the it has to be provided, sir. Actually, the auditor that the Rita has the right to ask the information. If they are not asking the providing the information, I think she need to give the opinion on this.
Okay. So, do you say that opinion should be issued in this scenario instead of a report?
Yeah, I mean report, not opinion.
Okay, report. Yep. Anyone else? Absolutely correct. They should, or CA reader should issue an opinion, sorry, report in this scenario. But now, there are two things to understand over here. And for that purpose only, I brought up this question. First of all, this is not an statutory engagement. This is not a statutory engagement. You are being hired as a CA because you have the expertise knowledge in the presentation and preparation of the financial statement. Now, if you later on identify something wrong is happening, for example, in this scenario, CA Rita observed that the company has not recorded any provision for gratuity payable in its employee, which is mandatory requirement as per the AS 15. Okay. She brought the attention to the management. Management responded. They do not wish to make a provision and it would reduce the profits, which they reported to the bank for the new loan. This is window dressing. What is this window dressing? A type of a fraud where you manipulate financial reporting. Okay, you show a very rosy picture. This is fraud. Now, as a practitioner, as a chartered accountant, maybe not providing, assurance of this, but still just a chartered accountant. Do you think you should be associated with any kind of fraud?
No, sir. As per the ethical requirement, we need to if they are not ready to give accepted the report, then we try to withdraw from the engagement.
Absolutely. Very good. Yes, Megha, you are also correct. So, in this scenario, our job is not only to compile because the moment you are a chartered accountant, you have a responsibility. Now, tomorrow, if you compile a financial information where you think there are some issues, there are some, do you think you have something, to identify or to report? At that point in time, your report along with this makes a very useful tool, provides a useful tool to you to report that particular part. We will go and see now the reporting segment first so that you can understand what to report, how to report, and how this engagement works in actual. So these are the things, element. Okay, the practitioner should include in his report. So the practitioner report issued for the compilation engagement shall be in writing and shall include the following elements. Number one, what you have compiled. First of all, the report title, what is it is about, to whom you are addressing, a statement that practitioner has compiled the financial information based on the information provided by the management. Tomorrow, it should not happen that they come back to you and say that no, you compiled by your own. We did not provide to you the information and you compiled by your own. We relied and we are now in trouble. Okay. So, this particular report will be a scenario or will be a tool for you to demonstrate how this engagement has been performed. The outcome. This is to support the outcome. A description of responsibility of management. Identification of the applicable financial reporting framework. Identification of financial information, including title of each element of financial information. Tomorrow, let's say you only compiled balance sheet and management, goes to every regulator and says that no, no, this entire financial statement, consolidated standalone, has been compiled by this particular chartered accountant. We relied on that and we are not responsible for that. A description of responsibilities, practitioners' responsibilities. Why? Let's say you are sending the financial statement to management, and tomorrow management says, no, we asked that particular person to audit the financial statement. He just compiled it. We never asked him to compile. We asked him to audit. We asked him to, identify the issues in that. We asked him to do a forensic audit. How will you at the end, demonstrate that no, it was not your responsibility with the financial statement? One way is to go back to the terms of engagement. But that's why also advisable when you are presenting your final outcome on the financial statement, give this report. This will demonstrate what you have completed. A description of what compilation engagement entails as per this SRS. What is compilation engagement? And then explanations that since the compilation not an assurance, practitioner is not required to verify accuracy and completeness of the information. And accordingly, the practitioner does not express an audit opinion. Otherwise, they may, if you do not include this point, they will make this report as an assurance report. You have to specify this is not an assurance report. This is something just we are doing a clarification, okay, on the financial statement that is being provided to you. If it is being prepared as per the special purpose, then special purpose financial reporting you need to specify. Describe the purpose for which the financial information is prepared and draw the attention of the readers to the report or to the fact or information that is prepared in the special purpose, if it is special purpose. And the date, practitioner signature, and place of signature. These all things, again, states what is your responsibility and how the compilation is done. So that tomorrow no one can say that that particular charter accountant has done a window dressing by not identifying the issues in the financial statement. Okay. It may happen, let's say, for example, the way is given in the question AS15. Tomorrow management says, no, we were not aware. The provision is not there. How we can make the, rectification when we were not aware even? Like, there is a provision required. Everything will come on the chartered accountant who did the compilation. Now he is responsible for the fraud, window dressing, even though it's not an assurance engagement. So, to avoid those kind of scenarios, this report is an excellent tool. Now, what if management does not rectify? Where you will report? Where you will, include that particular thing in your report? In that particular scenario, if management does not rectify the financial statement, okay, if management does not rectify the financial statement, do not issue a report. Simple. Reason because understand one thing that report is required to be issued. This is not an assurance engagement. You cannot issue a qualified report. There is nothing as such qualification or something like that. Okay. If you issue a qualified report, that means you are allowing management to use those financial statements in which there is a problem. Is management mandatorily required to circulate this report along with the financial statement? Is there any legal provision or legal requirement to circulate this report with all whosoever is receiving the financial statement? Yes, no, no. There is no such requirement. Correct, Megha? If there is no such requirement, then how can you make sure that your qualification in the report reaches to everyone whosoever reads the report? even though management does not rectify it, is it possible for you to verify? Answer is no, because there is no mandatory requirement for you to make sure that report goes to everyone. In that case, even if you issue a qualified report and provide the financials with the qualified report, the financials are misleading. They are going to be misleading. And as a result, in that particular scenario, you will be held accountable. So, whenever there is an issue in the financials, if you identify the compiled financial, if you identify the compiled financials do not adequately refer or describe the applicable financial reporting framework, or amendment to the compiled financials are required, okay, in order to be not to be materially misstated, or compiled financials are misleading, in that particular scenario you may propose the appropriate amendments to the management. Please make this an amendment. If they do not make the amendment, if management declines or does not permit the practitioner to make the proposed amendments, in that case, withdraw. Withdraw from the engagement and inform the management why you are withdrawing. Inform those charges with governance why you are withdrawing. If withdrawal not possible, see, in most of the scenarios, it will be possible unless and until your terms and conditions and the engagement letter you have signed does not allow you to withdraw because of some hefty penalties or something like that. But rare case scenario, rare case in this kind of engagement, rare case scenario. So if withdrawal is not possible at all, okay, determine your legal responsibilities. But in no case you should issue a report. Okay. And even at the end, the practitioner is required to obtain an acknowledgement from management and those charged with governance that they have taken the responsibility for the final version of the compiled financial information. Even if they rectify, even if they make the necessary changes, you have to make sure you obtain an acknowledgement that this is the final version and they will use this. So, having said that, we have a report, but still in that scenario, we are not allowed to issue a qualified report because it's not an assurance. We cannot issue a report on factual findings as a qualified because qualification comes as a part of the assurance, not on the non assurance related things. I hope I'm clear.
Clear.
Okay, so now let's go back to the question that we were discussing. In this particular scenario, what do you propose? What should CA Rita should do in this scenario? Anyone? What CA Rita should do in this scenario? We have discussed just now.
Yes, sir. As we discussed, he has to bring this matter to the management and so George's governance. If they are not ready to incorporate the changes, then definitely the auditor will withdraw from the engagement and also provide the reason for why she is withdrawing from the engagement.
Absolutely. Very good. So when you go and write the answer, like at that time, we will specify SR as 4410, not an assurance. Okay. Practitioner is not required to be associated with the financial information that is known materially misleading or misstated. Okay. Then if you identify issue, okay, if you become aware of anything which is not appropriate, okay, inaccurate, incomplete, unsatisfactory, bring to the attention of the management. Okay. And if propose the amendment to the management, if management refuses, withdraw. When withdrawing, inform them about this. You analyze the situation, what is there with CA Rita. Okay, there is a material omission in this scenario. CA Rita is correctly identified, management refused, and as a result, she must refuse, withdraw, and upon withdrawal, communicate. Simple. So this is how will be the answer for this particular question. Any doubt? Okay. If no doubt, let's proceed for the further discussion. Now, one thing we understood: if there is an information which is incorrect, inaccurate, okay, in that case, bring to the attention of the management, and then based on that, if management is ready to rectify, fine. If management is not ready to rectify, withdraw. Okay. So in the course of compilation engagement, practitioner becomes aware of the information that is either incomplete, inaccurate, otherwise unsatisfactory, bring to the attention of the management. Okay, if you are unable to complete the engagement because management has failed to provide you records, documents, explanation, withdraw and communicate the reason for withdrawal. Okay, now this is for the last steps that we were talking about, performing and reporting. But before this, we have some few things also to understand. The first and foremost requirement comes is the accepting the engagement. Now, what do you think? What is the requirement with respect to the acceptance of engagement? Anyone? What is the requirement for acceptance of the engagement here? Anyone? Before you accept the engagement, what you will do? We have discussed this now only few times, some moments ago. So before you accept the engagement, you will make sure that you comply with the requirements of ethical requirements, fundamental principles. And do you think independent is mandatory in this engagement? Yes.
Not mandatory.
Yes. Very good. Not mandatory. Okay. Uh, you are correct. So again, ethical requirements will be there. We have to comply with the ethical requirements because code of ethics, it's applicable. You are into a public practice. Whether or not you are doing an assurance engagement doesn't make any difference. You are a chartered accountant in public practice. Okay. And the code of ethics is applicable to you to the fullest. Okay. So ethical requirements are applicable. Perfectly fine. Independent is not mandatory because it's a non-assurance engagement. So independence requirement do not apply. However, if there is a requirement of the disclosure, you must disclose that you are not independent. Clear? Okay. Now, we will take one question or we will discuss one particular scenario basically. Okay. We will discuss one scenario. Over here, yes, Samanathan, SQC1 will be applicable because it's applicable to all the type of engagements, whether assurance, non-assurance. SA220 will not be applicable because it's only related to audit. Okay, so SQC1 will be applicable, standard for quality control of firms. But SA 220 will not be applicable. It is applicable only to specifically audits. Okay. Now, one important point that I want to discuss here is once you comply with the ethical requirement, then what is the next scenario that you will adopt here? Or what is the next requirement that you will fulfill? What is the next step for you? Anyone?
Planning.
Before planning. Even before planning. Document these in record. Okay. Let's take a question to discuss that particular part. Because again, this is a non-assurance engagement. And trust me, when these kind of engagements are there, no, at that point in time, it becomes very, very important to understand how our work will be used. Okay. So let me discuss one more question on this particular line. Let's read this question.
CA. Samir, a practicing chartered accountant, is approached by the directors of Next Trend Fashions Limited, NFL, a newly incorporated private company, to compile its first financial statements for the year ended 31st March 2025. The directors state they need the compiled statements to provide to a private equity (PE) investor for a first round of funding. During the initial discussions, the directors propose the following. They do not want to sign a formal engagement letter as they consider it a mere formality that wastes time. They are willing to pay the fees in advance to show their commitment. They inform CA Samir that he must prepare the financial statements on the basis of accounting they have determined. This basis includes recognizing revenue at the point of customer inquiry rather than dispatch of goods to show a stronger revenue pipeline to the PE investor. They also state that since CA Samir is the financial expert, he will be solely responsible for the accuracy of the underlying accounting records and the significant judgments, like provisions or estimates, and management will not take any responsibility for the same. CA Samir is keen to accept this new client. Advise CA Samir on the preconditions for accepting a compilation engagement in accordance with SRS 4410, revised, and whether he can accept this engagement.
Now, take a minute, read this question again, and then we will discuss. Okay. Now tell me, what do you think in this particular scenario? What CA Samir should do?
Sir, on point number one also, he need to get that engagement letter not received. That is one is conflict. Point number second also, as per the management direction, he has to prepare the things, but that is not appropriate. He has to prepare as per the financial report more. The point number three also, the sole responsibility of the judgment, like accounting estimate 540, say 540, that all management responsibility. They have to prepare and they have to provide. Accordingly, he have to incorporate in the financial statement.
Okay, yes, very good. Anyone else would like to add further to this? Okay, should not accept. Fine. See, first one, they don't want to sign a formal. That is not appropriate. We should have a writing. What is the problem in the second one? Like, okay, it's a compilation. As I said, it could be historical financial information, it could be other financial information. And the basis of accounting can be special purpose, can be, normal general purpose. If they are giving their basis of accounting, is it a problem? Okay. Okay, Megha. Good. Anyone?
The revenue recognition is not as per the applicable financial reporting framework.
Okay.
In this case, it could be India, not in accordance with India's 115.
But what if they say this is a special purpose framework?
Sir, special purpose framework it will be accepted, but it is not a special purpose assignment, I believe, because the management only giving direction. There is no specific document or agreement is not shared with them, with the auditors.
Yes. Now, see again, now there are few things that we need to understand. When we are doing an engagement of compilation, okay, management may come to you and say, no, no, this is a modified version, modified accounting financial reporting framework, and you have to compile. This is not an audit, you have to compile as per them. But at the end, we are talking about either special purpose or let's say modified financial reporting framework or general purpose financial reporting framework. The intended use and the financial reporting framework should be appropriate. For example, the intended use for the of the financial information here is for the private equity. They are the intended users. Okay. Now, if the financial reporting framework, which is used for the intended users, let's say, for example, contract, there's a contract with the private equity that requires them to prepare in this way, then it may be a different set of questions and discussions that, okay, the contract requires in this way. But if there is nothing to that particular extent, which means there is no contract which requires them to prepare in the basis of customer inquiry, and no one will ever do that. In that scenario, the information over here does not seems appropriate for the intended user. So the applicable financial reporting framework, which is either specified in the applicable law, regulation, contract, other form of agreement with the third party, or as a part of governance and accountability, arrangement within the firm, within the company itself, or as voluntarily adopted by the entity, what it can be, but that has to be appropriate for the purpose of the intended users. Whatever you do, you say it, whatever financial reporting framework you bring, it has to be appropriate for the intended users. In this particular scenario, showing revenue on the basis of customer inquiry rather than the dispatch of goods, it's not appropriate for the intended users. Number one. Number two, it is a misreporting, not a special purpose framework. There's a difference between special purpose framework and incorrect reporting. Okay. So let's say, for example, in previous scenario where AS15 was applicable and we were not applying, I could say special purpose framework. I'll not apply AS15. That is not the case. It's not a special purpose framework. where you don't apply AS 15. But in that scenario, you have to understand whether what is the intended use of the financial information. Is it going to be misleading for that particular intended use? So, if let's say, for example, financial information is to be provided to private equity, would it be misleading to the private equity if they will go through this? Or what private equity is expecting from this financial information? Are they expecting that this financial information to be prepared based on customer inquiry? Who does that? So, you are preparing a financial information which will be misleading for the intended users, and naming that particular part as a special purpose is a blunder. Okay. Then, as a result, in this particular scenario, it's not a special purpose. Third, that Samir is a financial expert and he should make the significant judgments. Management will not take any responsibility of that. If you agree to this, then it's a problem. Because in our audit report also, we have understood that management is responsible for presentation and preparation, and they are the responsible for making significant judgments, provisions, and estimates, not us, not even a chartered accountant. They cannot assume the responsibility of the management unless and until he is part of the management. But till the time he is not part of the management, he cannot assume a responsibility which is specifically given to the management. As a result, in all the three scenarios, these conditions are not acceptable at all. These are not at all acceptable. As a result, when you go and you get these kind of engagement, the first thing is understand what is the intended use and distribution of the financial information. Is there any restriction on its either use or distribution? Number two, identification of the applicable financial reporting framework. Very, very important. What will be the applicable financial reporting framework in this scenario? Reason because if you are associated with a materially false or misleading statement, if you are associated with a statement or information which is furnished negligently, if you omit or obscure any information required to be included where such omission is misleading, which provisions of professional ethics will be applicable? Which provisions of professional ethics will be applicable? Anyone? We have seen no? Chapter number 19, schedules to the Chartered Accountant Acts. Which provisions will be applicable over there? No? I think you guys are not practicing enough. You should be remembering those schedules to the CA Act, and these are the very important one. Very important. No? Okay. So, second schedule, part 1, fails to report a material misstatement known to him appear in the financial statement which he is concerned in the professional capacity. Remember, although you are taking this engagement, you are, chartered accountant in practice. So part 1 of schedule, first schedule and second schedule will still be applicable to you. When I talk about clause 5, 6, 7, 8, over there, it is being said that, like 8 is on the opinion, but let's say 7 does not exercise due diligence or is grossly negligent in his professional duty. Taking this assignment, performing this assignment is a professional duty. You will be grossly negligent if you accept this kind of things. Second, this is a disclosure. Here, if you disclose the revenue based on customer inquiry, it will be counted as you failed to disclose a material fact known to you, okay, in a financial statement, but disclosure of which is making financial statement, would require much more clarity in that scenario. Now, if you are concerned with that financial statement in a professional capacity, you will be held guilty of professional misconduct. So, one side, disclosure was necessary. You are not disclosing that material fact, means revenue over here. And you are concerned with the financial statement in the professional capacity. Professional capacity means you are taking an engagement on that financial statement. It's a professional capacity. You will be held guilty under clause 5. You will be held guilty under clause 7. So these clauses will be applicable in that scenario if you are, issuing a report here. Are you understanding the point? Plus, other liabilities for the auditors will trigger into, it's not only these liabilities, but other liabilities for the auditor will also trigger into in this kind of scenario. It may be counted that, you are providing false information to third parties. Maybe. Okay. Or you are providing any false information or something like that if this is going to a regulatory authority or somewhere else. That depends upon the engagement. But again, this can lead to professional liabilities on you. So that's why he should not accept this engagement, first of all. And before accepting, verify those things. Verify the financial reporting framework, objective, scope, responsibility of your practitioner, responsibility of the management, accepted form and content of the practitioner report, and then record all these things in the written. So we will go to the study material. First of all, when it comes to the engagement acceptance and continuance, identify applicable financial reporting framework, objective scope of the compilation engagement, responsibilities of the practitioner, responsibilities of management for preparation and presentation of financial reporting, financial information. It is ultimate responsibility of management for design, implementation, and maintenance of internal control, for accuracy and completeness of the records, for judgments that needed to in the preparation and presentation of financial information. All these things are the responsibility of the management, not of the practitioner. And that's why in our report, when we discussed our report, what we discussed is that since it's a compilation engagement, not an assurance engagement, practitioner is not, sorry, practitioner is not required to verify the accuracy, completeness of the information provided by the management. I hope I'm clear. Any doubt with this? Any doubt? No? Okay. If no doubt, then let's proceed. And few things are pending in this particular part. That is one, the expected form and content. So you have to specify that in your engagement letter itself. That is the expected form and content. Okay. That should be there. Number two, once you take up these kind of engagement can be recurring. Recurring as in means, for example, let's say you are doing a quarterly financial compilation, quarterly financial information compilation. In that particular scenario, what will happen? That you are doing engagement letter once, but you are doing compilation every quarter, recurring engagement. At that point in time, before start of each engagement, you need to make sure, is there any change in the circumstances? Okay, on the terms which you accepted earlier. So if there is a change, then you need to remind the management that, okay, we need to revise the engagement letter. Okay, we need to get a new engagement letter because there's a change in the terms. So if there is a change, remind management at the time of existing terms that this has to be revised because of the change. It may happen that, it's a recurring assignment, quarter on quarter, month on month, a lot of things can be there. Okay. And then a few things on the performance side. We have already discussed on the performance, but there are few things. Number one, when you do a performance, when you perform this engagement, compilation, directly do not compile. Understand first what you need to compile, kind of as a 315. Understand the entity, what is required to be compiled. Okay. Then you practitioner shall compile based on the information and everything which is available to you. Like, you need to consider all the things, but for that, have an understanding of what business is, how is required to be compiled, what are the relevant documents and everything. And based on that, you perform the compilation. So that is something, and then you need to communicate to the management that we have discussed already multiple times. Reporting part is there. Quality control, as we discussed, will be applicable SQC1. Documentation you have to maintain for each and everything. That's the basically SRS 4410. Any doubt? So there is one question. In the point that you just explained that the auditor is not required to check the accuracy and completion of the information. Then in the question that you had shown earlier relating to non-inclusion of provision of guarantee, how we will report it, or should the auditor check only the correct disclosure? See, very good question. Now, I see that practitioner is not required to verify the accuracy and completeness of the information. Fine. We say that. But that does not mean that we are not required to check what information we are being given. It's a compilation engagement. You have to make sure it is not misleading. And to make sure it is not misleading, you have to perform some procedures. But by having this particular point over here, I am saying practitioner is not ultimate responsible person. Okay. Practitioner is not an ultimate responsible person who is required to verify the accuracy and completeness. Are we hired for the verification of accuracy and completeness? Answer is no. We are not hired for verification of accuracy and completeness. No, it's not our job. But still, we have to make sure it is not misleading. Means we will perform certain procedures. Now, to what extent and whether they see again, always there will be a limitation. Okay, you cannot go till the level of each invoice. Let's say, for example, compilation engagement is being given to you. Management gave you, this is the detail of revenue. What you will do? You will take that detail, you will see on the face whether it's misleading, how it is calculated, what is the accounting policy which is applied on the basis of which it is calculated, and then you will use for compilation. Will you go and perform the invoice testing? Will you go and perform and check whether the agreements actually is there with the vendor or sorry, customer? Whether the goods have been actually shipped on which the invoice have been booked? No, we are not going to do that. For example, management gave you these are the datas as of 31st March 2025. You will do analytical procedures just to understand whether they are appropriate or not, complete or not. Okay. But what if there is a deliberate, misreporting to you? The list which is given is not correct. Will you go and check whether the payment received in front of each data has been applied appropriately? Whether all the invoices are booked? Whether the data balance is as per the confirmation? For example, management gave you inventory. You went through, you saw provision is there. Now, will you go and perform physical verification? Answer is no. So, we will perform some procedures, but we are not responsible for the accuracy and the completeness of the information. Understand? These are the assertions. Remember, we saw the assertions in SA 315. These are the two important assertions with respect to the information. That is not our job. I hope I'm clear. Any doubt? Any doubt? No? If no doubts, let's take one more question. Okay, again, a good question on the similar lines, and it will really help us to understand this particular concept in much more detail. Uh, Let me share this. Yeah. Let me read the question for you.
CA. Reena is approached by the partners of Sunrise Medical Clinic, a newly formed LLP. The partners, who are all doctors, maintain their accounting records on a strict cash receipts and disbursements basis, as this is how they wish to evaluate their performance and distribute profits. They have engaged CA. Reena for a compilation engagement under SRS 4410 to prepare the financial statements for the year ended 31st March 2025 on this cash basis. The engagement letter, drafted by CA. Reena, clearly states this basis of accounting. During the engagement, one of the partners mentions that he plans to submit these CA-compiled financial statements to a bank to apply for a large business loan for the clinic. CA. Reena knows that a bank would typically expect financial statements prepared under the accrual basis, as per as and the cash basis statements might be misunderstood, as they do not reflect outstanding creditors or receivables. Advise CA. Reena on her responsibilities under SRS 4410, revised, regarding the intended use and distribution of the financial information she is engaged to compile, and the specific actions she must take in her compilation report to address this situation.
Okay. So take a minute, read the question, and then try to answer. Okay. So what do you think in this particular scenario? What CA Reena should do? What CA Reena should do in this scenario?
Yes, sir.
Okay.
Actually, the basis of accounting as well is talk about the three things. That fundamental principle, accrual concept, consistency, and going concern. See, that part is talk about the accrual concept. See, the CA Arena to prepare the accounting as per the this basis for accounting using the rule concept. But in this case, they are asking to prepare in the gas basis, which is not. Sir, I feel it is inappropriate, sir, on this.
Inappropriate. Okay. Anyone else with a different answer or something further to add? If a management wants a special purpose, FS-based cash basis accounting, then reference the arena paper cash basis, but should be only used. Okay. Okay, Mika. Very good. Anyone else would like to add to this further? Misleading information, discuss with the management, withdraw if they don't agree. Okay, Hetal. Good. Okay, I'll tell you, there are two things to understand over here. And there is a specific reason why I have taken this particular question. Just to understand the role of financial reporting framework and special purpose financial reporting framework. See, cash basis of accounting is permissible under income tax law also. It is the financial reporting framework. Okay. And cash basis of accounting is a permissible financial reporting framework as per the income tax. Okay. Now, can I call that as a special purpose framework? Answer is yes. That's a special purpose. Cash basis is a special purpose framework. And the question comes is whether this is a special purpose framework or this is a misleading. See, here the Sunlight Medical Clinic, which is a newly formed LLP, maintained by all the doctors, they strict maintain all the accounting records on a cash basis. So originally their accounting basis is a cash only. It's not the accrual basis. Okay. Now they wish to evaluate their performance and distribute the profits, like because they how they want to maintain their account. So it's a cash basis. Now they have engaged C Arena for compilation, not for the conversion. It is not the conversion from cash to accrual, and they have hired for the compilation on the cash basis. And the engagement letter, which is drafted, clearly states that basis of accounting. So everywhere it is cash basis. The only point is that C Arena is aware that the financial statement, which is supposed to be given to the bank for the business loan, okay, bank typically requires financial statement on accrual basis, and the cash basis might be misunderstood. So to avoid that misunderstanding, it is misunderstanding, not misleading. Remember, there is a difference between both. Now, to avoid this kind of misunderstanding, specific reporting section are there. Specific reporting section is present. In report, we saw that you have to mention about the special purpose framework. There is a area which is given. So if we'll go back to the report, in the report, we have this particular part. If the financial information is prepared using special purpose financial reporting framework, an explanatory paragraph that describe the purpose for which the financial information is prepared, and if necessary, the intended users contain a note, a reference to a note in the financial information that discloses this information. This is nothing but the kind of EOM para. Remember the EOM para we have shown, kind of EOM para that bring the attention of the users on this particular point and draw the attention of the reader to the fact that the financial information is prepared in accordance with the special purpose may not be suitable for other purpose. This kind of thing in the financial statement, because see, disclose this information in the note of financial information or statement basically. So in financial statement, make sure this is disclosed, that it is on the cash basis. In your report, you do the COM paragraph, you have the COM paragraph, then it is fine. It will not be an issue. But you have or you are required to have this kind of arrangement in your report. Clear? So if I go to the answer, basically you need to evaluate the intended use, objective and scope of compilation engagement. Okay. Then you need to talk about, is it a special purpose framework? The financial statement or information may not be suitable for other purpose that is required as per the SRS 4400, that you are required to mention these kind of paragraphs. Okay. Analysis. We are doing the analysis of the question here to avoid the misinterpretation. Okay. We need to provide this particular thing. So the intended use is submission to bank or loan. Intended user is bank for whom this special purpose may not be suitable or misunderstood. As a result, you may or you are required, okay, to have this note, because the original intended users or the original understanding was of the management. It was required to the management. Later on, you understand, okay, it will also be given to the bank. Okay, a financial statement can have many intended users. So it may be suitable for one, may not be suitable for others. As a result, have this mandatory explanatory paragraph in your report that clearly states that the financial statement has been prepared in accordance with special purpose. Draw the attention of the reader to the note. State the result that the financial information may not be suitable for other purposes. So this is how you need to deal, or CA Arena needs to deal in this particular scenario. Any doubt? Okay. If no doubts, can we take one more question? Very, very good question I have on this, the same topic. Okay. Again, it will really help us to understand this particular topic. Just a minute. Let me read the question.
MS Bloomfield Florists PVT Limited. BFPL, a medium-sized enterprise, does not require a statutory audit under the Companies Act, 2013, based on its turnover and borrowing limits. For internal management purposes and for submission to their bankers, with whom they have a long-standing relationship.
What I'll do is I'll remove the word private limited because everyone requires an audit. I'll just remove the word Bloomfield Florist. Not a company act, but it will be a partnership. Okay. Or income tax act, basically. So, just a small clarification. Income tax act, now it is 2025, but 1961. So they do not require any audit under
based on its turnover and borrowing limits. For internal management purposes and for submission to their bankers, with whom they have a long-standing relationship, the company engages CA Aman to assist them in preparing their financial statements for the year ended 31st March 2025. The terms of engagement, clearly documented in an engagement letter, specify that CA Aman is engaged to perform a compilation engagement in accordance with SRS 4410, revised. CA Aman completes the engagement, assisting management in compiling the financial statements from the company's trial balance and other records. The management of BFPL is satisfied with the compiled financial statements. However, the director of BFPL provides CA Aman with a draft report on the company's letterhead for him to sign, which states, "We have compiled the financial statements of Bloomfield Florists PVT Limited based on our compilation. The financial statements are presented fairly, in all material respects, and give a true and fair view of the state of affairs of the company." The director insists that this language is necessary for the bank to accept the financial statements. As CA, Aman, analyze this situation. Explain to the director why you cannot issue the report they have drafted. Also, list the essential elements that must be included in the practitioner's compilation report.
So here, basically, there is a partnership firm. This BFPL is a partnership firm. Okay. Now, understand a medium-sized enterprise and partnership firm. So I'll just add that for the clarification. Now, this does not require the statutory audit or tax audit, basically under the income tax act based on the turnover and borrowing limits. So, for the internal management purposes, they want to submit to the bankers. They have prepared and they have engaged CA Aman to assist them in preparing and presenting the financial statement for financial year ended 31st March 2025. Now, the terms of engagement clearly documented in the engagement letter specify that CA Aman is engaged to perform compilation engagement. Now, CA Aman here completes the engagement, assisting the management in compilation financial statement from the firm's trial balance. Okay. And then basically he but he after performing the particular engagement, the management of BFPL is satisfied. Like, okay, fine, this is a compilation. However, the director or you can say partner in this scenario, okay, of BFPL says that okay, no, you have this particular point in your report, that is that you have compiled the financial statement of Bloomfield, okay, based on the compilation, okay, information that was given to you, but you say that it is presented fairly in all material respect and gives a true and fair view of the firm. Now the partner or the director over here, okay, he's insisting that okay, this language is necessary for the bank to accept the financial statement. As a result, explain to them why this can't be done and what is the problem in this. Oh, correction, yeah. So explain what is the problem in this particular language. We have compiled the financial information of Bloomfield Forest based on our compilation. The financial statement are presented fairly in all material respect and gives a true and fair view of the state affairs of the firm.
The language used is an audit opinion. This is
Yes,
not a compilation report.
absolutely correct. So this kind of language gives a true and fair view, is not of the compilation engagement. It is more onto the kind of a scenario where you are issuing an opinion. Okay. So in this particular scenario, it's not an opinion. At the end, as I said, it's not an assurance engagement, it's compilation engagement. We will not be issuing any opinion. As a result, this kind of statement is inappropriate in total. You should not use this language. Okay. And that's why you need to explain to the partner of the firm that why this language cannot be included. And the areas or the points that are required to be part of the compilation practitioner's report, we have already discussed. So the main point is this is not an assurance engagement, and as a result, having this kind of language gives a true and fair view, not appropriate at all. Clear? Straightforward question, nothing difficult here. Like just only the point here is don't include these kind of opinion in the report of the compilation engagement. Any doubt? Okay. If no doubts, what we can do is that, okay, this is the chapter number 9 that we discussed. Let's take a quick 10-minute break, and after the break, we'll start with the chapter number 10, review of financial information. Okay. We'll start with the chapter number 10, review of financial information, and we will discuss on that particular part. Let's take a quick 10-minute break. Thank you. So now we will start with chapter number 10. What chapter number 10 is about? It's about review of financial information. Basically, it deals with the review engagements. Here, we need to understand how review engagements are different, okay, from the other engagement that we have seen. Okay. So, what we have seen till now, audit engagements, we have seen related services engagement or related services. Later on, we will see engagements on other assurance engagements. Okay. But now we are looking on to our review engagements. These are review engagement that is known and the standards. Sorry. And the standards on these are known as SRE. That is SRE 2400, SRE 2410. Okay. So a standard on review engagement is called a SRE, standard on review engagements. Can anyone tell me what is the difference between a review engagement and an audit engagement? Difference between a review and an audit engagement.
It is a limited assurance engagement.
Okay, limited assurance engagement.
Here the
Very good. Yes.
procedures are less than the audit.
Procedures are less than the audit. Yes. What else?
Here a conclusion is given rather than the audit opinion.
Here the conclusion is given rather than the audit opinion. Okay. Yep. There is one more specific element to the report writing over here. Yes, Megha, very good. There is something to the report writing, the way we provide our opinion or conclusion in this scenario. Anyone? What is different here with respect to the conclusion or the opinion that we give? What is different? What is different? How we draft a conclusion over here is a very important point. Anyone? No? Okay. Let's go to a particular section only. Wait a minute. And we will discuss the first conclusion part. Why? Because then only we will be able to understand how a conclusion is given and how it is linked to the particular, you can say, whatever we are doing over here. So on page number 10.19, everyone, page number 10.19, we have unmodified conclusions. Yes, you are right that here instead of opinion, we call it conclusion. But the language is something that will decide that how and what we do. Let's say unmodified conclusions. What is the language over here is based on our review, nothing has come to our attention that causes us to believe that the financial statement do not give a true and fair view or do not fairly present in all material respect in accordance with the applicable financial reporting framework. Or based on our review, nothing has come to our attention that causes us to believe that the financial statements are not prepared in all material respect in accordance with the applicable financial reporting framework. What is this called? Anyone? What is this called? This type of conclusion. What type of this conclusion is? Anyone? What is different between this conclusion and the conclusions that you have in your audit?
In audit, we say financial statements give a true and fair view or present fairly. Here it is a negative assertion type, negatively presented.
Yes, very good. So here it is written in a negative format. Okay, kind of a negative assurance that based on our procedures, what we did, we have not identified anything which can lead us to believe that there is something wrong with the financial statements. So here we are issuing a conclusion, no doubt in that. But the conclusion which is issued is in the kind of a negative statement that nothing has came to our attention. Okay. So here we are giving the conclusion, but in a way that we are specifying that, okay, our conclusion is based on the procedures we have performed. Like if something has came to, would have came to our attention, we would have reported, but nothing has came to our attention based on the procedures performed. That's why we are not reporting anything, or we think everything is fine. Remember the negative confirmation we discussed in one of the standard, which was the standard that negative confirmation.
70 uh, 705, that disclaimer of opinion.
External confirmation, negative confirmation.
Yes, SA 505.
Very good. SF505. We discussed about the negative confirmation in the external confirmation, wherein we discussed that if nothing received, we will assume everything is fine. If no reply received, we will assume everything is fine. This language is that only. If nothing came to our attention, means everything is fine. That's a low level of assurance. Remember, we discussed that negative assurance or negative confirmation is a low level of confirmation. Yes or no? It is similar to that. This part is similar to negative confirmation. That's why it gives low level of assurance. It gives a low level of assurance. That's the reason we have a low level of assurance. Now, based on our review, this particular part, very important, no? Based on our review, what review we are doing? Based on our review, nothing has came to our attention. Now, what review we are talking about? When I talk about a review for financial information or a financial statement, okay, when we talk about a review of financial information or financial statement, we need to understand what it means, what actually review includes. So, review is kind of the inquiry and analytical procedures that we perform. In review, we perform analytical procedures and inquiry, or inquiry and analytical procedures. So, by performing inquiry and analytical procedure, if nothing comes to our attention, we say that no, we nothing came to our attention, and we believe that the financial statement are prepared in non-material respect. That's a limited assurance, which is reduced to a level that is acceptable in the circumstances where the risk is not greater than the reasonable assurance. Means here, like what I'm saying in this scenario is that in this kind of engagement, where I'm issuing a limited assurance by performing analytical procedures and inquiry, I'm giving A low level of assurance, not good for the high risk, but it is good for the low risk. If you want to place a high reliance on that particular financial statement, this level of assurance will not work. This level of assurance will not work at all. So you have to provide in that scenario different kind of assurance. That's a reasonable assurance. But when I don't want to place that much reliance on the financial statement, or the risk is low, risk of material misstatement at the entire financial statement level, or it is the reliance is very minimal, or reliance is not that much high. At that point in time, limited assurance can be issued. Clear? Okay. Now, I'll come to the point where we are discussing about the review engagements. Again, back. So we understood review of financial information means we are talking about now in this particular whole chapter review engagements. This is assurance engagement. Okay. Again, this is assurance engagement. That means although limited assurance, I will say limited assurance, but this is assurance engagement. So here we will issue instead of opinion, because it's a limited assurance, we will issue conclusion, not the opinion. Okay. and because it's an assurance engagement, there is another requirement now which will be applicable, which is independence. Independence will be applicable because assurance is coming back in the picture. Ethical requirement plus independence. Everything will be applicable. Okay. Again, assurance engagement, ethical requirements, independence, everything will be there. Fundamental principles will be there. Professional skepticism, professional judgment, SQC1, everything will be applicable. You understand audit, correct? Now, to understand review, I will just ask you to trim it down a bit. There is nothing new here. Trust me, when I talk about review of financial information, it is not something new. I am only asking you to perform selective procedures of audit. I am asking you to do half audit. That's it. Again, it is an audit, but in a half nature. So we are performing, analytical procedures and inquiry. There are other procedures also in audit, but I'm not asking you to perform that here. Rest, everything will be same. So if you apply an inquiry, it will be same like an audit. If you apply analytical procedure, it will be same like an audit. Okay. So again, the review is a limited assurance. We understood what is a limited assurance. Now, standard on review. There are two standards that we will discuss about over here. One is SRE 2400, which is basically governing the engagement to review historical financial information. SRE 2410 is basically governing review of interim financial information. And that has to be performed by independent auditor of the entity. Here, it can be performed by practitioner. That means it can be a chartered accountant in practice. It can be auditor of the entity, perfectly fine. They can be anyone out of it. But in this particular scenario, it has to be performed. SRE 2410 has to be performed by the independent auditor of the entity. Confirm. It has to be the auditor. Okay. Now let's understand what is the responsibility of the practitioner here. So the responsibility of the practitioner, it's pretty straightforward. The objective of the practitioner in this particular kind of scenario is straightforward. Obtain limited assurance, primarily by performing inquiry and analytical procedures. That are the objectives. So you perform uh, inquiry, analytical procedures about whether the financial statement as a whole are free from material misstatement, and then issue a conclusion that nothing has come to your attention that cause you to believe that they are not prepared in all material aspect in accordance with the financial reporting framework. That is the limited assurance. If I talk about from here to here, it is nothing but the limited assurance. Number one. Number two, report. Prepare a report. Okay. Now, if I ask you to perform inquiry, how you will perform inquiry? Let's say I ask you to perform review engagement. What are the things you will take care, or what are the steps you will perform? What are the things you will perform? Anyone? How will you perform this review? Same procedure a case of reasonable assurance, understanding the entity, nature, operations. Yes, Mega, correct. Anyone else? How will you perform this inquiry or review engagement? If I ask you,
Yes, the same way we will ask the management to provide that any related party transaction, is there any identified any fraud or going concern assumption or material misstatement, like that we will ask all the inquiry. Is- Whether they prepared the financial statement in accordance with the financial reporting framework.
okay. So, yes, you are right. But whenever it comes to, performance of an engagement, we have to think from the start, all these steps before accepting, after accepting, planning, performing, reporting. So when I talk before accepting, client's acceptance and continuance, again, quality control will come into the picture, ethical requirements will come into the picture, and that they are applicable at the engagement level. See, SQC1 is applicable, no doubt in that. But each standard also specifies its own quality control requirement. So every standard has a quality control requirement embedded in that. Okay, where which asks the practitioner to comply with the ethical requirements. SQC1 is applicable at the firm level, the firm which is providing these services. But again, that has to be, applied through this particular standard at the individual level also. So every standard will have a quality control requirement embedded in that. Now, as a practitioner, you are required to comply with the ethical requirements, even independence in this scenario, because it's an assurance engagement. And before accepting the engagement, again, as we have discussed, the scope, purpose, intended users, financial reporting framework, because it's a financial statement, we have to go for the financial reporting framework. And very important part, is it appropriate to perform a review engagement in this scenario? That is something we need to understand. Is it appropriate to perform a review engagement in this scenario? That means if, let's say, for example, management requires an audit and asks you to perform a review, is it appropriate? So you need to consider whether it is appropriate to perform the review engagement in this scenario. When there is a requirement of performing a review engagement, rationale should be there. Okay. So, for example, let's say management is saying, I want an annual audit, but I don't have a time. Perform a review, give me a review report, I will submit. Do you think it is appropriate at that point in time? Let's say contract requires, let's say a partnership firm. partnership agreement requires mandatory audit year on year, irrespective of the turnover and everything. Now, instead of that, one partner appoints you for the review and says, instead of audit, perform the review. Or the managing partner says, perform the review. Will you perform the review? Is it appropriate to perform the review in that scenario? Not appropriate, because the intended use purpose does not require the review, it requires an audit. So, if you should not accept a review engagement if you are not satisfied with the rationale or purpose of the engagement. That the review engagement would be, you should only accept when the review engagement would be appropriate. If you think a review engagement would not be appropriate in this scenario, you should not accept. Again, if you believe that you cannot comply with ethical requirement, do not accept. If you believe that the engagement is something, like your understanding of the engagement indicates that, you will not be able to perform the review, okay, or the review that you are performing will not serve any purpose, should not accept. So if the review or will be unavailable or unreliable, do not perform. Doubt on management integrity, do not perform. Okay. If there is an impose on the limitation on the scope of the practitioner's work at the time or before accepting the engagement itself, do not perform. So, if there is anything which is imposing a limitation, causing a disclaimer of conclusion, doubting the management integrity. See, why doubting the management integrity is involved into this? Because any which ways you are giving low assurance by assuming there is a low risk. But when I say doubts on management integrity, it gives me high risk. It denotes high risk. Then how a low risk opinion would be appropriate in this scenario? It will not be. Doubt on management integrity will not be appropriate because there is a high risk. And my opinion is for the low risk, not appropriate. So you should not accept the engagement when these kind of things are present. And what is the precondition for accepting? The same way we have in SA 210 preconditions to accept an audit. That acceptability of the financial reporting framework, management acknowledge their understanding its responsibility, providing access to all information to the practitioner for the purpose of review, okay, unrestricted access, and before accepting, determine which financial reporting framework to be applied. Same like SA 210 that we have discussed earlier. Because I said it is kind of an audit, but to a limited level. It is an assurance engagement, but at a limited level. So you need to understand financial reporting framework, its acceptability. In case of special purpose framework, then understanding of that will be required. Intended users will be required. Obtain the agreement from management that it acknowledge and understand its responsibility for preparation, internal controls, all access to the information, unrestricted access to the person, additional information that you may request, everything same that we have seen in SA 210. Are you understanding the point? We are not discussing something new in this scenario, the way we have discussed in agreed upon procedure. Agreed upon procedure, no conclusion, it was a different scenario. But here, it's a limited assurance. Assurance is there. Procedures will be the same because at the end, my subject matter, which is being reviewed, is nothing but your historical financial statement. So I will not be discussing anything new which you are not aware of. Yeah, there were few things, opinion part, we discussed that because the wordings are different. And that's why I took that part first. If preconditions are not available, do not accept. Communicate with management. If they are not ready, then in that case, you shall not accept the engagement. unless required by law. And when it will be required by law, we will see a scenario. Let's say, for example, if it is required by law that you are required to do the review engagement as per the law, and you are not able to comply with the SRE, in that point in time, mention in your report the practitioner shall not include any reference with respect to the practitioner report that it is conducted in accordance with the SRE. Rather, you should mention it is not conducted because of the limitations. Okay. Again, agreeing to the terms that we have already seen in SA 210, obtain the understanding, inquiry, and again, here the scenario is that you are going to perform inquiry and analytical procedures, nothing else. Inquiry and analytical procedures. So, do you think the rest of the essay will be applicable in this scenario? From SA 200 to SA 700 series, do you think that will be applicable here? Yes, no?
Yes, will be applicable.
Okay. Anyone else? Do you think essay will be applicable? So, essay will not be applicable.
Sir, essay will provide the opinion, but here is a conclusion is given.
Yes, very good. See, essay is for audit. This is not an audit. Essay 800 special purpose audit, still it was audit. That's why I said essay will be applicable. This is not audit. This is review engagement. You will see similar requirements like essay, but essays are not applicable. SRE is applicable. Okay. So we will discuss about materiality. We will discuss about procedures like inquiry and analytical procedures, but it is not essay. It is SRE only. So the specific provisions of the essay which are applicable in this scenario are brought into SRE. Okay. So you need to determine materiality for the financial statement as a whole, apply this materiality at the designing procedures. So we will be talking about this is similar, not applicability. So it's similar to SA 320, which is not equal to applicability or application of SA 320. Understand? There is a difference between both. I'm saying, and everywhere I will use the reference, it is similar to that, it is similar to that, it is similar to that. That does not mean that you apply that essay. That means only we are borrowing the concept to understand what is the requirement over here. We are borrowing the understanding of what we have learned in audit to understand what is the requirement here. Clear? So, materiality, obtaining understanding, similar to essay. Which one?
315.
315. Yes, similar. Again, designing and performing audit procedures. Address all the material items in the financial statement. Focus on addressing areas in the financial statement where material misstatement are likely to arise. Similar to SA 330. Okay. Then you perform the inquiry to understand inquiry depending upon the the engagement. If it is the historical financial information, we will perform inquiry accordingly. If we want to cover non-monetary transactions, we will perform inquiry accordingly. Okay. So it is not necessary that inquiry will only be performed for financial information. It may be performed for the non-financial information. You may perform inquiry for the going concern. You may perform inquiry for the events and conditions after, the period close, that subsequent events. So all these things will be there. I am going to look into the going concern, events and conditions that count the significant doubts on entity's ability to continue the going concern, material commitment, contractual obligations. Then after that, non-monetary transactions, everything will be there. Fraud, event occurring after the balance sheet date, all these things will be considered. I am going to consider all these things in this particular engagement, but from the part of view of inquiry and analytical procedures, nothing else. So I may perform inquiry on the regulatory related areas. I may perform inquiry based on different things, or I may perform analytical procedures, okay, on records, on things to understand how the trends are. We have discussed analytical procedures in detail. So that is the second area that I will do. All the areas will be covered, but from the point of view of analytical procedures and inquiry. That's it. For example, related party. I will perform inquiry and analytical procedures for the related party areas. Can anyone give me an example? How will you perform analytical procedure and inquiry from the related party area? Anyone? How will you perform that? Anyone? How will you perform analytical procedure or inquiry with related party area? No? See, let's say for example, when it comes to related party area, I'm giving an example. What I will do, I will inquire with the management. Management, this is the last audited financial statement. These are the related party disclosed over there. Can you tell me, is there any difference between the related party that is disclosed here and disclosed, and that you are going to disclose in the financial statement on which I'm going to perform limited review? Management will say, no, there is no change. I said, fine. No change, fine. I'll apply the analytical procedures now. I'll compare the related party transactions with the financial statement, audited financial statement earlier present, and the related party transactions that are there appearing to be on my financial statement, which I've taken for the review. If I find additional, that means there is something issue. And then I will discuss a part where I need to perform additional procedures if I identify something. But this is how I will perform analytical procedures and inquiry. For example, I'm performing the inquiry. Management, do you think, have you identified any fraud during the year? Is there any whistleblower complaint? Have you identified any instance which is of suspected fraud? Then they will say, no, we have not identified. I said, fine. Give me the internal audit report. Once I'll get the internal audit report, I'll perform the analytical procedure. Okay. And we'll see, is there any fraud related reporting in that for the current year? Simple. Or I may say that, okay, management will say, no, the fraud in the current year is similar to what we reported in the last year. There are no increase in the number of instances. I may perform a trend analysis. What is the trend of the fraud reported or identified by the internal audit team? Or what is the level of whistleblower complaint? So all these things I will do from the related party, fraud, entities, and ability to continue as a going concern, all these things. So related party, which essay? Similar to which essay?
550.
Fraud and non-compliance with laws and regulations.
240.
Laws and regulation to 250.
250 laws and regulations and essay. Fraud,
The fraud 240.
240.
240. Yes. Going concern.
So going concern,
570.
Now, how will you perform the analytical procedures and inquiry over here?
okay. Analytical procedure 520.
No, no. But how will you perform on the going concern area? Simple, straightforward. You will ask management. When I talk about inquiry, you will ask questions. Think when you think inquiry, think of a question. That I will ask management. Management, have you performed the going concern assessment? If yes, what period you have covered? What instances you have covered? Have you identified any material uncertainty? Do you think there are events or conditions that cause significant doubts on entity's ability to continue as a going concern? Management will give you answers for that. Then go on to the financial statement,
We will do
perform the
the
ratio analysis
ratio analysis.
to understand liquidity ratio, current ratio, profit margins, losses carry forward, unabsorbed. A lot of things are there. In analytical procedure, you can check. You can check a trend of cash flow from operating activity decreasing day by day, year by year. You can see there is an accumulated losses more than my net worth. You can see the current liability, current ratio is pathetic because of the high current liability and lower current assets. I have more of a liability than the assets I have. So these are the conditions, events that may cause significant doubt. Then you will go again to the management. Management, have you considered all these things in your assessment? Management will say either yes or will say no. Then accordingly you decide if they have considered. Then it's fine or not. If they have not considered, then we will talk about if you identify an issue. Okay. Use of work performed by others. Simple. We may involve auditors expert. We may involve, another reviewer who is reviewing, let's say, for example, review on the consolidated financial statement. But for that, you need an individual reviewed or audited financial statements, first of all, standalone one. So we may use work performed by others in this particular scenario. Now, if you get information, if you are aware of any matter which cause you believe that there is a material misstatement or the financial statements are going to be materially misstated, means if you identify a problem, simple, what you should do? And the answer is design and perform additional procedures to obtain sufficient, okay, to enable the practitioner to conclude that the matters are is not likely to cause the financial statement as a whole to be materially misstated. Number two, determine whether the financial statements are materially misstated or not. That means design this additional procedures to evaluate whether is there a material misstatement or not. Now, this additional procedure, this additional procedure is inquiry and analytical procedures only. So do I need to perform more inquiry and analytical procedures? What is additional procedures here? Do I need to perform more additional procedures? That means more inquiry and more analytical procedures?
I think it would be other than analytical procedures and inquiry.
Anyone? So in this particular scenario, not only analytical and inquiry, other procedures also, which will include substantive procedures.
Test of details. Test of
Yes, similar to test of details. So I will write similar to, not exactly, similar to test of details. Why similar to? Because it is only targeted to that particular area where you are identified issue. Maybe one sample, maybe two sample, maybe three contracts, limited, very limited. Okay, so you may perform additional inquiry analytical procedures, or you may perform substantive test of details or external confirmations. Both are there, but at the end, you need to achieve this. You need to check whether there is a misstatement, material misstatement. If yes, then report. Then we will give the conclusions accordingly. Okay. And after doing the procedures, do you have sufficient information to say you don't have a misstatement? So you need to confirm that particular part by performing the procedure. What procedures? Professional judgment. I will not comment on that. That is, you have to decide as a reviewer what procedures you need to perform. But at the end, you need to understand whether there is a material misstatement causing the financial statement to be misleaded. And if yes, then do you think the financial statements are materially misstated? So, yes, no, both you have to confirm. It's not something that I will, okay, I perform the procedures, I'm not able to identify anything further, so I assume that nothing is there. No, not like that. You have to conclude that the matter is not likely to cause the financial statement as a whole to be materially misstatement or materially misstatement. So the word which is used is you have to conclude whether the financial statement are materially misstated or not. That means you are required to have a conclusion for that.
Sir, here that the word sufficient and appropriate audit evidence is not there. Only the procedure for sufficient only is there. That is a reason we are not going into details of desktop details and desktop control. We are not doing. Am I right, sir?
Yes, that's why I'm talking about sufficient procedures here based on the issue that you have identified and limited to that particular issue only, not the entire financial statement line item or the population. Clear? Any doubt? Okay. Now, similar then, other procedures that we have seen, written representations, uh, subsequent events. For example, over here, we have events occurring after the financial statements or the auditor's report, both. Okay. First of all, practitioner has no obligation to perform any procedure regarding the financial statement after the date of practitioner's report. Okay. Similar to SA 560. Simple, that we have understood. That if there is any event after the date of practitioner's report, okay, but before the financial statements are issued, a fact become known to the practitioner that it would have caused the practitioner to amend the report. Similar, discuss with the management, determine whether financial statement needs amendment. If so, then inquire how management intend to address the matter. If management does not amend the financial statements, then practitioner shall notify the management and make sure that you prevent reliance on the practitioner's report. If you identify events occurring between the financial statement and the date of practitioner's report that require adjustment, ask management to make those adjustments. If it requires a disclosure, ask management to make a disclosure, etc. not adjusting one. Similar to what we have seen in SA 560. Then written representations, again similar to what we have seen in SA 580. All these written representations we will obtain from them of all the areas. If management does not provide, then discuss the matter why they are not providing, re-evaluate their integrity, take appropriate action, and determine the possible impacts on the conclusion. So whatever we are discussing in review, it's the applications of the concepts, the procedures we have understood in the audit, but in a limited way. Again, the dates covered by the written representation near to the date of financial statement. All these things that we have understood as of now is the same that is applicable over here. And at the end, you need to understand whether you have a sufficient and appropriate evidence that you have obtained from your procedures to form a conclusion. Now, here, sufficient and appropriate evidence is related to forming a conclusion, means forming a limited assurance conclusion. At the end, whatever sufficient and appropriate audit evidence I'm talking about, it is with respect to the limited assurance. And if you have, then issue the conclusion. If not, then perform the additional procedures similar to what we have SA 450. Yes or no? And same that is there in the 700 also, forming an opinion. Now, forming in conclusion. It is same. I'll trust me. It is same. Nothing different over here. The part which was different, we already discussed. If there is an uncorrected misstatement identified during the review, okay, you need to understand what a misstatement it is, okay? Or if it is a qualitative aspect of the entity's accounting practice, okay, and you think that it is causing the issue with respect to the overall financial presentation, structure, content, at that point in time, you may issue a modified conclusion. But in drafting the conclusion, you have to consider all these things: uncorrected misstatement, qualitative aspects, overall presentation, structure, content, the way we do in audit. Okay, whether financial statements, related notes appear to represent fair presentation. Okay, so all these things, if you are fine, issue an unmodified conclusion. We have seen the wordings of that. If you are not fine, issue a modified conclusion to that. Now, which kind of modified conclusion? Okay, which kind of modified conclusion we can issue over here? So in audit, we have qualified, adverse, disclaimer. Yes or no? What do you think? Which kind of conclusions we have in case of modification over here? Anyone? Anyone? Which kind of modifications do I have available in this particular part here? No? No answers? Okay, not an issue. See, as I said, it is same just like audit, but in a limited sense. So when I say same like audit, I have qualified conclusions, I have adverse conclusions, I have disclaimer of conclusions. Instead of opinion, it's a conclusion. Concept is same. Do not deviate from the concept. So if I determine based on the procedures performed and the evidence obtained that the financial statements are materially misleaded, or if I'm unable to obtain sufficient and appropriate evidence to form the conclusion on the financial statement as a whole, in that case, I will issue a modified conclusion. Now, modified can be qualified, adverse, disclaimer. When disclaimer, when the effects or the giving rise to the modification are material and pervasive. Qualified where material but not pervasive. Disclaimer where the possible effects are material and pervasive. And this is the kind of example based on our review, except for the effects of the matter described in the basis of qualified conclusion paragraph. Nothing has come to our attention that causes us to believe that the financial statement do not give a true and fair view or do not represent fairly in all material respect in accordance with the applicable financial reporting framework. Based on our review, except for the effects of matter described in the basis for qualified conclusion paragraph, nothing has came to our attention that causes us to believe that the financial statement are not prepared in all material respect in accordance with the applicable financial reporting framework. Paragraph for the qualified conclusion. Similarly, you have for the adverse conclusion over here. Based on our review, due to significance of the matters described in the basis for adverse conclusion paragraph, the financial statement do not give a true and fair view or are not prepared in all material respect in accordance with the financial reporting framework. Similarly, that what we have seen till now in the SA 706. And if you do like this way, if you provide qualified opinion, modified opinion, adverse opinion, disclaimer of opinion, describe and quantify the financial effects, explain how it is misstated, describe the nature of omitted financial information if there is an omitted financial information. You have to provide this in the basis of the conclusion paragraph, whether it's a qualified, adverse, or whatever it is. And if the undetected, uncorrected misstatement, then the possible effects of that is material and pervasive, it will go for a disclaimer. Disclaimer conclusion. So when you have a limitation due to scope, limitation on scope of review, you are not able to gather the evidence to show that what is the possible effects on the financial statement of undetected misstatement and which is pervasive and material, means disclaimer for opinion. Okay. And when withdrawal is possible under the law, in that case, withdraw. Simple. Means limitation is there, disclaimer of opinion is there, withdrawal is permitted. At that time, first prefer the withdrawal instead of issuing a disclaimer of opinion. Here, any doubt? Now, we will talk about one important point, that is report. We will talk about the report of the practitioner. But before that, again, as I said, it is the kind of a mini audit or a limited audit, but in a limited sense. So the question is, do you think emphasis of meta paragraph, other meta paragraph will come into the picture? Do you think it is necessary to have these paragraphs or you can have these paragraphs?
No, sir.
Anyone other than that? Like, what do you think? Should we include these paragraphs? Anyone know? Can I include emphasis of a meta paragraph, other meta paragraph in this scenario?
I think yes.
See, again, as I said, it is kind of an audit in a limited sense. So, answer is yes, you can. It can be, and there can be an emphasis of meta paragraph, other meta paragraph in the practitioner's report. If you consider it necessary to draw the attention of the user, you feel free to do that. Okay, it's your professional judgment. So you can include an emphasis of meta paragraph. If you think it is necessary to communicate a matter other than those presented disclosed in the financial statement relevant to the practitioner's responsibility, report, or understanding of the review, feel free to include other meta paragraph. Similar to essay, which one?
706.
06.
706.
But the 700 series is not applicable to this. However, in the standard itself is given like UOM and other meta paragraph can be included in this report. Am I right, sir?
Yes. So
Okay.
whatever we have discussed, it's not the essay. These are the part and the concepts or the requirements embedded into the SRE written. SRE does not refer to materiality or SA 240, SA 320, 315. No. Rather, it explains how to apply those things in case of the review. It says that you need to perform inquiry, this is how. You need to understand the business, this is how. Which is similar to the audit only. Reason because when I talk about understanding the entity, it will not be different. You are not, for example, understanding the entity. The way we understand the entity in the audit will remain the same or is going to be the same in the review itself. You are not going to perform something drastically different in review. Like in case of audit, we understand the entity by performing the inquiry, understanding the documents, or in review, you will say that no, 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 let's have something new. Let's be the employee of the company and then perform the understanding. No, it is not like that. You are not going to perform something new altogether. It is the concepts that we have understood are being applied in the case of review with a modified version. Similarly, when I talk about reporting, whatever we have understood, for example, emphasis of meta paragraph. Emphasis of meta paragraph is for the drawing user attention to a matter which is there in the financial statement. It is not the case. It will not become an qualified opinion. So when it comes to the review, you will not find that okay, emphasis of meta paragraph is used for qualification. No, it is not going to happen that. You will not see like it's not something a scenario where in the review now we are using other meta paragraph to report key audit matters. It is not going to be that. If it is emphasis of matter. The way we have discussed in audit will be the similar. If it is other matter, it is other matter. Now the question comes is, can it be a key audit matter paragraph? Key audit matter. Can we include that? What about key audit matter? Anyone?
No, sir.
So with respect to the key audit matter, answer is no. The reason because it's not an audit. It's a review. And there is nothing as such key review matter.
Yes, sir. That's what I am also thinking.
Yeah. So there is nothing as such key review matter. There is key audit matters. It is not an audit. That's why it's not applicable over here. And we have not understood or gone through any concept as a key review matter. It's not there. So it will not be applicable. However, if you want to draw the user attention to a matter which is there in the financial statement, you may still use emphasis of matter paragraph. Okay, but again, it is not for the qualifications. It is not for the modified conclusions. No. other reporting responsibility. Yes, it is going to be there. For example, if there is any other reporting responsibility with respect to the regulatory or legal requirement that you are required to report in the what you can say practitioner's report, this will form part of this particular head or section, other legal and regulatory requirements. Clear? Any doubt till now? So it's a combination of all the standards, but the relevant paragraphs which are there, okay, and applied in the cases of a review.
Yeah, it's looked like we have to use all the standards, but the thing is it only a limited review and conclusion only we are giving.
Yes. Now, last and important part of this particular standard that I want to discuss is the report. How the report is there, how the report is drafted. And again, I will tell you, you will find a lot of similarity between the audit report and the independent practitioner's report in case of a review engagement. So, first of all, you have a title, independent practitioners review engagement. Okay, you have a title for independent practitioners review report. The way we have independent auditors report, here independent practitioners review engagement. Okay. You then have an addressee. You have an introduction paragraph to identify financial statement, title of each statement, date covered, okay, refer to the summary significant accounting policies, other explanatory information, and state that they have been reviewed. Similar, what we have seen in audit. A description of the responsibility of the management. Okay, that preparation is their responsibility, internal control is their responsibility. If financial statement are special purpose, then reference to the description of the purpose for which the financial statement are prepared, intended users, okay, and that particular information that is there. If management has a choice of financial reporting framework, then provide which choice they adopted. Okay. Basically, when it comes to the special purpose framework, always verify purpose, intended users, okay, and you can say kind of usage or like like who will be having the access of this particular financial information, whether it is reported or not. Let's say, for example, if there is a financial statement, special purpose financial statement. So, what is the purpose? What is the intended use of that particular financial information or statement? Who are the users that they will receive that particular financial, statements? And the last one is, you can say kind of that whether it is referred in that financial statement, that whether they are the special purpose one or not. You can say notes or information, or you can say reference which is there. I usually call it notes that are required to be there in the special purpose financial statement, that they are special purpose, they are not the general purpose. It's kind of a pin set of scenario. Always verify that. Then practitioner's responsibility. Then you specify something about the review of financial engagement. This is something specific to the review. What is this? That a review engagement under SRE is a limited assurance. Practitioner performs inquiries and analytical procedures. The performance of procedure in review are substantially less than those performed in audit in accordance with the essay. And practitioner does not express an audit opinion on the statement. After that, conclusion. Okay, whatever conclusion you have, and if you have a modified conclusion, okay, then you need to provide the basis of modified conclusion. A paragraph that it is a modified conclusion, a paragraph Okay, description of matters giving rise to modification. So this is modified conclusion and basis of that. In last, you have an reference to the SRE, that obligation is there to comply with the SRE, date, sign, place, you did. That's it. So this is how a review report is there for the historical financial statements. Any doubt? Any doubt? Okay. If no further doubts, can we like with respect? Okay, there is one question. So like live example for this. See, again, I'll tell you, live examples for this particular report is very rare. Okay. For the next standard, we have live examples. I will discuss that. But for this particular example, okay, it is very difficult. Reason because these are the review of historical financial information, not the interim one. And as per the law, there is very less requirement unless and until there is a listing or something like that. Apart from that, there is very less information available for the review. Okay, in most of the cases, when there is a review, when there is a listing as of today, there is an audit requirement, not a review requirement. But the next standard, which is there for SRE 2410, review of interim financial information, ample of examples available. Amples. So we will discuss one good example, a live example in this scenario. But unfortunately, I don't have a live example for the SRE 2400. Yes, no, any doubt? Okay. If no doubt, then let's take one question to understand this particular topic. Okay. And again, as I said, this topic is not something new that we are learning for the first time. It's a limited audit, limited assurance engagement, kind of. Okay. So this is something we have already seen. Just a minute. Let me share my screen. We'll read the question and then we will go to the points which are asked one by one. First, we'll go to the scenario.
CA. Rashi has been engaged by Apex Solutions Pvt. Limited, ASPL, to perform a review of its financial statements for the year ended 31st March 2025. ASPL is not required by law to have its financial statements audited, but its bankers have requested a practitioner's report on the financial statements, and management has determined that a review engagement is sufficient. In accordance with SRE 2400, revised, CA. Rash's procedures consisted primarily of inquiry and analytical procedures. During her analytical review, she noted that the company's revenue had increased by 30%, but its salaries and employee benefits expense had decreased by 5% compared to the prior year. This was highly unusual, as the company's business is service-oriented and revenue is directly linked to an increased number of billable employees. When CA Rashi inquired about this, the finance director explained it as better optimization of non-billable staff. However, he was unable to provide satisfactory supporting schedules for the payroll or a clear reconciliation of headcount to revenue. CA Rashi suspects that the salaries expense may be materially understated, potentially by omitting contract employee provisions or other benefit accruals to inflate the profit before tax. Management is pressing CA Rashi to issue her report, stating that a review is just a limited check and she is not required to audit this area. As CA Rashi analyzed this situation by addressing the following.
So, the scenario is she is performing the analytical procedures under SRE 2400. During her analytical review, she identified that there is a 30% increase in the revenue, but its salary and employee benefit has been decreased by the 5% compared to the prior year. This was highly unusual because as a company, business is a service oriented and revenue is directly linked to the increased number of billable employees. When Rashi inquired, finance director explained better optimization of non-billable staff. However, he was unable to provide satisfactory supporting schedules for the payroll or clear conciliation of the headcount to the revenue. Now, CA Rashi believes that there is a potential material understatement of the this kind of payroll expense in this scenario. Management is saying limited review, limited check. You are not required to issue audit opinion. So, based on your procedures, issue an opinion. Now, the question here in this particular example, okay, is number one, what are the objectives of the review engagement under SRE 2400 and what level of assurance does it provide? What are the objectives of SRE 2400? Come on, guys, quickly.
To provide the conclusion on the historical financial information, and the level of assurance is the limited assurance.
Absolutely correct. So here we have to perform analytical procedure and inquiry in order to provide a conclusion that the financial statement based on the procedures performed, nothing has come to our attention that the financial statements are materially misstated. Okay, kind of a negative limited assurance we will issue in this scenario. What level of assurance? Limited assurance based on the review and based on the inquiry and analytical procedures that the review. So that's the objective. Number two, what is the practitioner's responsibility under SRE 2400 when during the performance of inquiry and analytical procedure, they become aware of the matter that caused them to suspect a material misstatement. If you identify a problem, what you are required to do?
Yeah, we will issue the report.
If
We'll
you
give you the
identify,
conclusion.
Discuss with the management.
cause them to suspect. If there is something which is causing you to suspect a material misstatement. Remember, we discussed about perform additional procedures, maybe additional inquiry review, maybe substantive to that particular extent. And at the end, obtain a conclusion. You have to get a conclusion whether there is a material misstatement or not.
Yeah, substantive procedure, like similar to the test of details.
Yes. So you are required to perform that particular additional procedures and you have to conclude whether the financial statement are materially misstated or not. Okay, that is the responsibility of the practitioner. And the last one, What are the reporting implications if CA Rashi is unable to obtain sufficient and appropriate evidence to resolve the matter? Come on, guys. This is easy. Pretty much easy.
She will be issuing the conclusion, modified conclusion.
Modified conclusion. Okay. Which kind of modification? Which kind of modification? So it will be either,
Material.
yeah, qualified conclusion if it is material. If it is material and pervasive, and we are unable to obtain sufficient and appropriate audit evidence for, sorry, evidence, not audit evidence.
Not
Do not
audit.
write audit evidence. Yeah. So if we are unable to obtain and the impact is material and pervasive, disclaimer of conclusion. If it is only material, then qualified conclusion. It will not be adverse because we don't have the evidence available. Clear? So that is one important question that I wanted to take up for SRE 2400. It primarily, summarizes the SRE 2400 in an appropriate manner. Any doubt?
Yes, sir. Compared to other standard, it's look like actually we are not used to do it, but need to do the more revision on these things.
Any doubt till now? Okay. If no doubts, then let me do a quick revision by taking 5 small MCQs, rapid kind of thing. I want a rapid answer from your side on these 5 small MCQs. Okay. It is a quick revision of SRE 2400 and SRS 4410. So I want a rapid answer from your side. Okay. Number one, an engagement under SRE 2400 review provides what level of assurance?
Limited assurance.
Very good. Limited
Yes,
assurance.
limited.
Compilation engagement under SRS 4410 involves the practitioner providing what level of assurance?
No assurance.
No assurance actually.
Very good. No assurance.
But they are telling high, moderate, negative. I'm reading all these things.
Yeah. The practitioner's conclusion in a review report is typically expressed in which form?
Limited assurance.
Limited, yes. Very
Yeah,
good.
limited.
In compilation engagement, SRS 4410, who is responsible for accuracy and completeness of the financial information?
The
Management.
management.
Yes. The primary procedures in review engagement consist mainly of,
Inquiry and analytical procedure.
Inquiry and analytical. That is the objective actually. Main objective.
yes. So, very good. We have completed SRS 4410 today, SRE 2400. Now, SRE 2410 is pending. The review of entering financial information by the independent auditor of the entity. Okay. In the next session, we will take up that and we will continue for the chapter number 11. Now, understand one thing. When I talk about SRE 2410, review of interim financial information, it is review. Again, it is review. Instead of historical, I'm talking about interim. There will be one or two specific areas with respect to the interim part, because I'm talking about interim. There is some special consideration for the interim. Apart from that, the things which we have discussed today will be applicable over there. So you are not going to perform a different kind of review. No. It will be review of inquiry and analytical procedures only. But just because it's an interim, there are some specific considerations to that we will discuss. Okay. So we will discuss that in the next session. And just a minute. So the next session is on today's third. Okay. Now the next session, you have a fifth open house query session. I would request you guys to attend that open house query session on 5th Wednesday. And then the next session is on 10th November for the chapter number 11. And this part we will cover in the start. It will not take more than half an hour or 45 minutes. We'll cover that and we'll go for the chapter number 11.
Okay. Next Monday.
Yes, on 10th.
Okay.
So in open house, you would be there.
No, I think the different faculties will be there. So the open house query session is on every Wednesday, 4 to 5 p.m. Any questions, any doubt, guys?
No, sir. Thank you so much.
Okay. If no questions or doubts, then thank you guys. Thank you for participating in today's session. I'll see you in the next session.
Okay, sir. Good night, sir.
Good night. Thank you. Yes.